Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Good evening, everyone. We'll let folks come in, but it's Wednesday, August 2nd. It's about 8 p.m. here on the East Coast. I see my boy Mike Taylor's out in the crowd, back-to-back weeks, buddy. Thanks for joining us. Busy few days, obviously, since month end. A lot going on, I think. Interestingly enough, there's kind of a similar discussion points in terms of top three things as last week, which would be volatility in general. You've got dollar and then rates, really. So those are kind of my top three things. I know I'm sure Mike T will have his own commentary on that, but why don't we just jump right into it? So anybody that's new to this call, this is the Weekly Notebook Review. They happen on Wednesdays, typically they're 4:30 or 8:30 in the evening. And what happens is that we're looking at kind of a midweek shift in terms of, what did we review over the weekend, kind of signals, kind of asset allocations that we were either interested in or reviewing or things that might be kind of teetering or improving, et cetera, and, how they perform in midweek and how do we set up here for the back half of this week, next week, next month, next quarter. We're in a fresh new quarter here, Q3. Earnings season is obviously in full swing. But we really kind of focus much more on the data and the numbers versus what the general narrative may be out there. Obviously, a big talking point is the U.S. debt downgrade by Fitch, and that's obviously a big deal. But at the same time, I think if we kind of stick with the signal and the data, that's really how you kind of block out that noise, right? Block out kind of what's actually transpiring, what the media is trying to get, pumped down your throat, and that kind of thing. So if we go with top three things, we're going to stick with, so let's go with volatility first, because I think that's the biggest component. We obviously focused on this a lot last week. If you didn't get a chance to listen, all of the replays are up on the Hedgeye podcast channel's YouTube channel. So you can find the replay here on Twitter as well. But again, Keith McCullough actually was on last week, and then Mike T jumped in at the end. It was a bit of a marathon. I think it was a 2.5 hour show last week, which they're usually about an hour and a half. But anyway, volatility was obviously a big discussion point. And my question that I was posing, and certainly I think we've been talking about a lot in the last few weeks, is what happens when VIX, volatility in general kind of spikes higher. And let's just use the VIX as an example here in terms of the S&P 500. So VIX closed at 16.10 today. It's a fresh, 1 month high in terms of the look back window. Moved kind of almost to the top of the risk range. The top of the risk range this morning was 16.76. The signal right now is neutral, but volatility and what's been transpiring in the vol space across the board. So if you look at VIX and RVX, OVX, GVZ, the move, so maybe not the move, but the move has moved down. But the rest of those have all been certainly been making kind of new lows or been kind of trading down at the low end of the risk range. So this is a new day today in terms of having volatility up. Keith covered his kind of SPY short in regards to the Red Eye Green Eye app. So he went from short from 2 days ago. I believe that was put on Monday afternoon to Z. So he's kind of snooze and bear. And I think an interesting comment of his from the RTA, from the coaching notes, was that the top end of his VIX risk range really wasn't moving much higher, and volatility wasn't getting the top end of the risk range, which had the refresh range kind of staying on the top side. Sorry, on the low end actually come up. So this morning, the low end of the risk range on the S&P was 4,487. On the refresh range, it was 4,510. We traded pretty much we closed at 554.13. So pretty much, right there, and kind of pushed down a little bit below that, kind of ticked a hair below the top end or the low end of the risk range. But it's going to be an interesting dynamic in terms of, what that looks like tomorrow. I suspect it's going to be pretty similar because VIX kind of traded right around that kind of 16-ish level. For a good portion of the day, it obviously pushed higher at one point and then kind of pulled back down. But the interesting thing here, and I think the thing that's I'm certainly most curious to see over the next few days in terms of signals and the setup is what happens with volatility in the VIX, basically over that time frame, right? So do we get vol sellers coming in? Anybody who's been long vol for the last few months, it certainly has not been paying off. So are they quick to all those long vol guys or girls? Are they quick to kind of sell into any pop, just kind of recoup some of the get some positive gains on the board? Or do we see something that's a bit more prolonged and perhaps prolific in terms of moving out of the investable bucket, which would be north of 18? So the chop bucket is 19 to 29 or 28 really, and so that could be where we go. And if we do see that again, which we had for a good chunk of last year, it's very possible that we see some further downside risk in the S&P 500 and really across kind of the U.S. equity space in general. I think the interesting component in terms of vol that popped, but still at the kind of near recent lows in regards to 10-day, 15-day, 1 month, 3 month, which is really kind of the look back windows that we leverage, is OVX, right? So you had to pull back in oil, but OVX, even though it was obviously a big move higher today, is still basically living right down by kind of the lows over the last month or so. So that's one where I think you've got it's shifted to a bullish trend, and that's basically been new in the last 4 to 5 weeks. And that's something where from an inflation standpoint, it could be a big driver here from CPI prints keeping the Fed hawkish and continuing to basically higher for longer, which has been kind of our nomenclature and where the camp we've been in for a long time now. What feels like probably almost 2 years, the higher for longer camp, but certainly 18 months or so. And I know Mike T and I have had many conversations about that. But anyway, so for oil, I think inflation that's been could be a good place to kind of be quote buying the dip, because this commodity landscape certainly looks like as I said, it's turned bullish trend, and from an oil standpoint, and there's certainly components inside of there like gold as well. A little bit of a volatility pop there as well, but still very much muted down at kind of 12.5. If you kind of look at the kind of historical landscape for gold and where GVZ stands, again, very similar, kind of right in the middle of where it's been trading the last like a month or so. But we were buyers of gold about probably midday or early afternoon through GLD. And again, this is something where getting long of precious metals, gold, silver. This is a great kind of to us. This is there's kind of like three assets, three general themes. If you kind of look at Keith's Mucker Family Office in the long only account, it's basically exposures to precious metals, Asia, aka EM, ex-China, and then you've also got some energy and energy related names like exposures like uranium, oil, XLE, that kind of thing. So that's kind of from a global macro standpoint, that's really where we've been hunting and we've been playing. Today, certainly with kind of to segue into the dollar move, those exposures really haven't enjoyed this dollar move over the last week, really basically ever since the yield curve control component from the Japan got basically released in the press. That almost immediately spiked. If you pull up the chart for DXY, you can see almost to the basically right on the number in regards to when that press release came out. The dollar moved from, call it 100.5, 100.5, and closed that day up towards 102. So, or around there, it's a huge move basically in a matter of in a very short window. And this continuation the last week has been a big change in terms of what we've seen over the course of the prior, say, month or so, where the dollar was failing and moved from basically neutral, right? So it was a bearish trade, bullish trend, but it had been kind of definitely had been weakening over the course of last month or so. And I think that had been a driver of basically, commodities, and especially oil in particular, moving to the upside. The gold inverse correlation, I mean, it was a completely different setup from a US dollar correlation standpoint last week versus this week, where on a 15-day basis, almost everything, a lot of things have burned off. And in fact, they have a bit of a positive correlation now. So, the BZE, so Brent oil, is a plus 0.87 correlation to the US dollar. Commodities themselves plus 0.88. And gold has moved from, what had been basically around a plus 9 or kind of high 80s from negative correlation down to negative 0.41. So it's going to be really interesting to see kind of what transpires with the dollar. If it does continue to have strength, then I think you're going to continue to see kind of this oscillation, which Keith has mentioned in the early look this week between quad 3 and quad 4 on those strong US dollar days. You're going to see much more, it's going to act a lot more like a quad 4 environment. And you saw that today, strong dollar, basically dollar up, rates up, volatility up, US equities down. And you saw, the only two kind of outperforming sectors today were both healthcare and staples. So again, those are basically typically quad 4 outperformers, along with utilities are basically flat. And then next up was real estate. So again, that's a pretty stereotypical kind of top 4 from a quad 4 standpoint. Now, real estate was down, minus 0.42%, so 42 basis points on a day-over-day basis. It hasn't really looked great in terms of real estate. Now, housing is a whole nother issue. ITB, we're actually long that one as well, and those have been great outperformers year to date, and probably really for longer than that, to be honest. But that's a whole nother dynamic. And Christian Drake put out a great note today on housing and the kind of dichotomy there between the demand and supply component that's happening within housing and ITB. But real estate's another beast. But again, I think it's going to be an interesting dynamic. I think having a portfolio that consists of winners and losers, right? So like winners that outperform in kind of in the quad 3, quad 4 environment, and then losers, aka on the short side, things that underperform in a quad 3, quad 4 environment. From a nowcast standpoint, we updated our model this week. So again, that's new information, new signals that are on the board. This is exactly what we talk about here on the weekly notebook review. We actually went out a quarter, so we now have about Q2 of 24 on the board, and it's looking at the moment quad 4, and then back-to-back quad 3. So we got back-to-back quad 4s here at the end of the year, and then quad 3s to start the year. So for those that aren't familiar with the quad model, quad 4s are basically decelerating or slowing both growth and inflation, and quad 3 is slowing growth but accelerating inflation. Now, just to preface that, it's very much kind of a coin flip over the next, not Q3, but in Q4 23, Q1, and Q2 of next year. Almost call it like 35, again, to round it off, about a 35% conditional probability, favoring quad 4 and Q4, but very much kind of, I think it's like a 32 or 33% conditional probability for quad 3. So, those next 3 quarters beyond this one here that we're in, really could kind of be, that's why Keith mentioned it as an oscillating quad 3, quad 4 environment. You're going to get quad 4 days, quad 4 weeks, quad 3 weeks, quad 3 days. And that's going to be, it's going to be challenging really to sort of navigate that, because some things like energy and commodities in general really don't enjoy a quad 4 at all. They underperform in a quad 4 environment, but they outperform in a quad 3 environment. Now, lucky for us, and one reason why we love precious metals at the moment, and we were a buyer today and have been a buyer for the last few weeks on basically down days, is precious metals. So gold loves quad 3, and gold certainly very much enjoys a quad 4 environment as well. So that's a great exposure to have on. That does work in both sides of the equation. Typically quality it does as well, but anyway, we won't kind of get into that at the moment. So to move on to the last point in terms of the top 3 things, and then I'll maybe Mike T, you can jump on. I know last week we talked a lot about price takers, right? Or kind of, anyway, I won't steal your thunder again, but I'm sure you got other things to think about as well, or that you wish to discuss. But in terms of the last component here, from me, it'd be rates. We've had again the kind of week over week a pretty pretty prolific move in the rates environment, and by that I mean kind of the U.S. yield curve, both really across the board, right? So from a signal standpoint, we've gone back to the bullish trend on both the 2-year, the 10-year, and the 30-year on the U.S. side of things. And the 10-year went pretty much right to the top of the risk range today. So we're kind of sitting at just over 4%, 4.09 to be specific, with that downside down to 3.77. So we've been seeing some pretty decent higher lows there, and obviously higher highs, but the higher lows are really important, and certainly be something to be paying attention to, because at the moment we really have the 10-year only kind of bottoming out or going to low end of the risk range, which would only get us back down to 3.77, and that really would get us kind of back to where we even just 3 months ago we were down at call it 3.4. Right. So just to kind of round it off, that 3.77 would kind of get us back just above the 1 month low. So that 1 month closing low is actually on July 19th at 3.752. So when you see something like this in terms of something in a bullish trend, rates certainly look very bullish at the moment. They're putting in new highs, and with this current low end of the risk range today, it would not be a new kind of 1 month low. So keep a really keen eye on those. We've sidestepped basically being longer duration TLT, IEF. We had IEF on the board. We're playing rates through BNDD at the moment, and that's kind of working for us. So we've been, a buyer. Went down the low end of the risk range. Last couple of days we've been kind of a buyer of that, and obviously paid that dividend a few days ago. So one of the benefits of obviously fixed income is you do get that. Typically they pay out the dividend kind of near the end of the month, sort of starting of the new month. But TLT has been just, I don't even know what good word, maybe dumpster fire. So it has been trading at, the one thing I will say is that it has, if you kind of scroll back a little bit or zoom out a little bit, it has been trading in a bit of a band. And we're kind of right at the close to the low end of that band. So it's going to be very interesting to me whether or not this is sort of this move to the top end of the risk range is kind of all it's got. I don't really know, but I'm going to let the kind of numbers and the data guide us here. But certainly higher for longer is the kind of the market shift, and pricing and rate cuts is really no longer really on the table. It's certainly been pushed off a few FOMC meeting timeframes, right? So this inflationary print, again, like in our environment, going back to our quad model, we've got it, as I said, oscillating. So, but really even the disinflationary kind of quarters are really quite nominal. They're, for the most part, it's kind of, we've got inflation from the estimate standpoint sticking kind of around that 3.4-ish, 3.5 level. So I think it's going to be, that's nowhere near the 2% that Powell and the Fed has as their target. So it's going to be very interesting. Could this be another push in terms of the U.S. continuing to hike rates and doing so at a faster clip or at a more aggressive clip than certainly what the market had been pricing in for the last few months. And then you've got an environment and I won't say it's one of many reasons, but certainly, Brazil cut their rates by 50 basis points today and said that they've got another 50 basis point rate cut most likely at the next meeting. So that's another good indication in regards to one of many reasons why we're long, or we like being long of EM and certainly EM ex China. Brazil is one of the names. India, Philippines, South Korea. These are all kind of EM countries that are certainly countries outside of Asia. Japan, how could I forget Japan? Japan's one of our largest asset allocations, but they benefit not only from a positive or a much better quad outlook from an economic standpoint than what we're facing here in the U.S. and Europe, but certainly in Brazil and Japan, we've got an easing central bank, which in conjunction with the kind of quad 1, quad 2 environments that we're seeing on the board as well. So that's all lining up very positively. That's exactly what you want to see, and that's one of many reasons, as I said, or really kind of the core reason that we are long of Brazil, Japan, India, South Korea, Philippines, et cetera, et cetera. So Mike, I don't know if you can jump on, but happy to have you come up. I think you had invite to speak. I see Trent Wizzo out in the crowd too. I don't know. He hasn't been on in here in a while, but so Trent, if you want to jump on, happy to have you up here. Obviously, there's a lot of great friendly faces out there. So if anybody's got any questions, I'm Mike T. How you doing, bud?
I'm doing okay. Thank you very much for having me. Very happy you did the call. I gather you do it every week per your mandate. So
I do it every week. I saw you had a little surgery though, man. You feeling okay?
Oh, they just dig into my spine, and sometimes I find gold.
That's good. It's if I need diamonds or platinum, you let me know, okay?
Yeah, I'm so terrible at trading gold. Like, I just don't do it. You guys, I just leave it to better. I leave it to
you
better.
Mentioned that. Yeah, you mentioned that last week, which made me chuckle.
Oh God, I just don't touch it. There's like so many things that, over 20 years, like I just can't do. So I just don't do it. What I do look at to talk to your dearest friends who's here on the line and the Hedgeye troglodyte community. What I wanted to stress last week was the negative pricing that we're starting to encounter, and it's just starting to happen. I thought it would happen around mid-year because, as you know, the unit growth for many, many things is negative. And the pricing power that they had on it was 10 to 15% for almost everything. And having negative unit growth and positive pricing power moving forward it's an impossibility. Okay. This is you're trying to swim with an anvil on your neck here. And you saw that in airlines where they said everything's great except we're going to lose pricing power moving forward and our labor costs are going to go up. Thank you very much. And autos said we're going to have to go back to meaningful discounting. We don't know where that discounting is going to go. Oh, and by the way, our labor costs are going up. Thank you. Good night. And we've seen just more of that in the companies that have been reporting. We're seeing like Starbucks. Starbucks didn't say anything about pricing power moving forward. They've had a lot of it. They don't have it now. Now they're worried. Now they're talking about loyalty rewards.
Yeah, and their foot traffic is spotting.
They're talking about, but our baristas are really efficient now. They're working more hours than they thought. This is going great. Well, that just means that they can't get another job. That's what it really means. So that's why they're there. So, Starbucks has had a lot of pricing, and they're going to probably have a problem. I don't think there's an instance where Starbucks has ever taken pricing down. And after the big move in pricing we've seen for everything, I think that we're on the beginning of a pricing cascade moving down. And this is helped by, high interest rates. Guess what? If you have an inverted yield curve and banks have less incentive to lend at a low rate or no incentive to lend at a low rate. And of course, you see the banks where the lending is bad. Especially all the banks throughout the middle of the country is bad. And debt growth is the fuel to the U.S. GDP. And what's making up for it right now is the government. We have massive government spending to try to keep our GDP up. But I think we're running into a giant problem. Tomorrow is actually going to be a very, very important day. If you pull up the Apple chart, it has been in an upward trend, zone. There's like a trading zone, and it's just up and to the right, and it's right at the bottom of that zone into its quarter tomorrow. You saw Qualcomm report tonight, and they said handsets stink. Thank you. Good night. That's not good for Apple, especially since we already know that their computer sales are bad. So. Now, granted, Apple doesn't trade. There are many stocks now that no longer trade like the fundamentals that are underlying. And this is largely because retail is all in. And we have millions more retail accounts than we did 4 years ago. a whole breed of new retail traders will come into play. And it's having a huge influence on meme stocks, get rich quick stuff. So I suppose in summary, we could go into huge details because a lot of it has to do with the BOJ and why now and how is that changing our yields, but it's bad and they're committed. So I just have layers of bad. The things that I can point to are really good is that, people still have jobs. So that's good. And that's like the only thing that I can point to. If anyone else has anything else that's really bullish, or let's say going to be really bullish, please jump in and tell me, because I'd really like to know. The setup for the next 2 years is meaningfully problematic. Oh, and I'm about 30% net short.
Robert McGroarty here, Director of Subscriber Development at Hedgeye. Join our entire research analyst team live before the market opens for deep dive investing analysis, our favorite stock ideas, and our risk manager in chief, Keith McCullough's macro overlay. Our team of 40 plus equity analysts discuss key market developments, trends, and our high conviction long and short investing ideas. You will not get this granular level of insight anywhere else. A video replay, audio version, and analyst summary notes from the call are available shortly after each live show to ensure you don't miss anything. Go to hedgeye.com/research to subscribe. And tune in live to the call weekdays at 7:45 a.m. Eastern. Enjoy the rest of this episode.
And we know you take that a lot bigger, but that's awesome. Yeah, I mean, on the Apple print and Amazon, both are tomorrow after market close. They came in the morning today. I'll be interested to see kind of what it looks like tomorrow, but they had massive eyeball premiums coming in, at the close, so kind of 2 days ago. So into the open, Apple was plus 85%, which was a plus 2.4 times on a trailing 12-month Z-score, and Amazon was plus 59% on eyeball premium, which is plus 2 times on the trailing 12-month Z-score. So both had huge prints. If you kind of look at the other names that have reported already, I mean, Tesla, for instance, I think has a sorry, let me pull it up so I'm not misquoting myself. Where did it go? I wrote down the big ones, but they had, Microsoft was negative. Tesla was negative. Let me pull up the actual number though. 1 second. Sorry.
I think in this point of time, we should also get some sort of rotation, right, Mike?
Yeah.
If we were to continue on this front. So maybe
Tesla was minus 8. Sorry. Go ahead.
Is trend WISO? It is. It is. I just wanted to...
We're getting this. We're getting the old band back together.
Yeah, I'm sorry we haven't talked.
I know the trend that you haven't been on in many months. Yes, good to have you. Good to have you back.
I missed you. I missed you.
I missed you.
We have a slow spot in the racing schedule, like pretty much here to October. So I'll be away like half as much. So that's good. So I can get
cool.
Cool. But I've been, I get surgery done, and then I'm still on all the pain meds, so I can get through it. I'm like at my computer for the rest of the day, and at my computer all day today, and trying to tie down what's going on. But you're absolutely right, Trend, the Wiz. You're going to see a rotation because they don't know what else to do.
Yeah. It is really almost like that simple. It's really kind of
Oh, yeah. And you could see it like immediately the pink book got spanked like 160 basis points in like 3 days. And that's because I had alpha positive momentum names in there that but it doesn't matter, because AMD pooched it and said, hey, things are really good, but not moving forward. Remember that AI thing? Yeah, it's not that big. And every stock, correlation of 1, night. And so you can just literally go through it and see where retail is. And honestly, it's factors. You couple that together, the huge factor move. And when I say guys out there, factors, it's attributes of the vector of a stock. It is not anything but that. Think of all of these little tickers as simple vectors out there, physics vectors. They have direction and they have momentum, and that's it. And what we've seen here is 9, probably 10 days of consecutive hedge fund disaster, meaning that it's been a huge factor unwind that really picked up today. I know a lot of guys in hedged books that are just throwing themselves out of windows because, their shorts go up 30% in 7 days of trading, and then today they drop 10. The models can't do that. Now, normally what would happen when stocks do this, the VIX would be way higher than it is, but it's not. And it is giving you a misread of what's going on. So there are normal metrics, benchmarks, rail guides, if you will, for how to run a book are awry. And a lot of that has had to do with retail call buying or retail put selling. And it has obscured what we're really looking at. So it's caused things to go straight up. And if Apple breaks tomorrow, the Qs have already broken the 20-day, by the way. That hasn't happened for like 6 months. It's just been up and to the right, closed near the lows, just about the lows, and broke the 20-day. And you just have to remember how retail operates. And there's millions of them. They are levered long, and when it goes down, they sell everything. And this was day one. So it's very, very challenging. Trend, I want to hear what you have to say because it is always not dumb.
That's a great way of putting it.
That's the way Ibar said. You only go down from there, right? Yeah, 52 week high. All right. So I had positioned my book for this month-end rally, right? And what I was doing, excuse me, for the last couple of months was I was just simply buying on around like 21st, 22nd of the month, emptying out the book, not carrying forward any risk. After the first or the second, of course, I missed certain parts of the value, but it was at least giving that peace of mind that, okay, I'm not getting the whole bunch of upside, which might exist during the intermittent days, but I'm at least not having a significant drawdown as well. And to that effect, as of yesterday, I had reduced my long side of the book significantly. I had not been doing a whole lot of active management for the last 2-3 months. I've been nursing a foot injury, some travel for work, as well as other things. And also taking care of my baby. She's almost close to 1 year.
I should add that Trend is like one of the most brightest people I've talked to. And I've talked to him offline many, many times. And he does not do this for a living. This is just like kind of a side gig. It is so goddamn impressive. I'm sorry. And yes, you are as good looking as you are intelligent.
Also true.
All right.
And yeah, it is incredibly impressive what Trent. It's crazy actually.
Right. And I'm looking for a sort of a rotation going in. So the hope or the idea is that when I say value, I want to steer clear of really bad balance sheet kind of value. So not looking for Verizon's or the AT&T's of the world, but looking for some decent high cash flow, but not significantly valued kind of value. So maybe a little bit of, and this would be more of a pair trade. So if I have a bit of a long value, then it would be short, paired with the short growth on the other side, and balance for geography as well. So within US and then outside US, I think we are up for rotation on both the ends, growth as well as value. So that's, I think that's where I am positioned for now.
So what you really like is Procter & Gamble trading at 23 times forward?
or some of the healthcare, or, in between when UNH got hammered, I got actually a decent position in UNH.
Yeah.
So those kind of things. Yeah.
Yeah. No, I've been migrating and doing very, very the HMOs are the back half of the year, except for I like Cigna, but because I think Cigna is going to benefit largely from this weight loss drug craze, which is really here to stay. This is going to be a gigantic category, and Cigna happens to have a large PBM business, pharmacy benefit manager business, and they are very likely going to benefit meaningfully on all these new scripts coming. They get a little spread on each one. And unlike the other guys, the other HMOs don't have such a big exposure to PBMs. So that's the one that I like. But net, I don't hate them all, the HMOs. I do think that they are going to have some utilization issues through the back of the year, but they're going to also be able to change their premiums, meaning hike premiums, for next year. And so it'll be fixed next year. And usually these HMOs will tread water until we approach the elections, and then they'll just rip. So I think that moving forward, the HMOs are good. I also like some of the tools, cap equipment players, if you will, in like Thermoelectron in the healthcare space, because it's non-economic, not too cyclical. They have a little bit of pricing power, and it's a roll-up, and it's usually quite reliable. So this is boring stuff. This is just to offset. What I'm looking at is I'm basically long like that, and then short negative pricing power. And yeah, I don't know. It's been a absolutely terrible trade all year, but now is when, and now I'm sized. So I really thought it'd be mid-year. But I'm sorry, Trent, keep going. You're like smartest.
Yeah, no, I thought it as mid-year as well, primarily from the whole Treasury having to, get the TTA account back up to the mark with the debt being gone. I was wrong at that time, and it did cost me a couple of 100 basis points. But then after that, I just decided to keep playing the month-end game, kind of work for the last 3 months in a row. But then now waiting for the next pain trade, or looking for the next pain trade. And I think there are some interesting things on that front. So one of them is discretionary, right? XLY. I think pain trade on that is on the lower side, but I would pair that up with something else, and I'm trying to figure out, would that be more on the XLK or something else? So I haven't yet quite figured out between those two. To do some work around the numbers and models, but I definitely think that consumer getting tapped out and Starbucks showing this kind of weakness as compared to the expectations on the street. That is a key part, that some of these numbers that are baked in are not quite accurate. And I'm looking at some of the numbers that even some of the PMs put in for Microsoft, more on the buy side, not on the sell side, were also quite extraordinarily hopeful. And they didn't end up quite monetizing as much as they thought they would. They came out with this hurried release of the Copilot thing, in which they said, okay, we're going to charge and upsell all of the AI-related products at 9 times the price, but there's not as many buyers for it. So it's to be seen. I think AI is for real, and then you have the companies incorporating that into their overall way of seeing business. But who seem to be the outright direct winner. I think there are very few players who got NVIDIA like Winpo in. So we'll see if even NVIDIA continues at this breakneck speed. So at the moment, I'm not positioned for tomorrow's sprint on Amazon or Apple, but if somebody were to ask me where would Apple head, I think just from a fundamental numbers perspective, I think they won't be able to meet the numbers that people are trying to work towards, and they would always have a spin on it, which I don't know how it would translate into the price. But for Amazon, I do want to present some insight. I found that the traffic on their website as compared to 2021 and 2022 wasn't as great, but it is baking in some better than expected growth numbers, both from a traffic perspective as well as reach perspective, which was kind of surprising because I thought that overall people were moving more towards services than goods, and they should take a bigger beating. But it seems like on a free cash flow perspective, they're starting to see some uptick and gains starting one quarter ago.
Well,
so those were all.
Are you still tracking? Hey, Trent, are you still tracking or Wiz? Are you still tracking? Wasn't it the Alexa data?
So there's Alexa data, there's similar web data, and these are proxies, right? It's part of the mosaic theory, so just one part, and then one has to balance that out with the actual models and the overall picture and have a probabilistic outlook, right? So this is a probabilistic outlook. Can it be wrong? Yes. One has to be very open to being wrong.
Oh yeah.
Well, it might be one of those things where it's not about hitting the numbers; it's that the numbers that you hit aren't good enough.
Right.
And you can see that on both. You can see that on both of them, right? You can see that on both Apple and Amazon. It's going to be. Yeah, it'll be an interesting evening.
Look,
/Friday.
You're as big as Amazon and Apple. You have to take into consideration for the back half of the year that millennials, probably 20 million of them or more, are going to start paying back their student loans. And that is going to have a profound impact because it's at the same time that Cap One and Discover are paring back their credit growth because they don't like what they see. And usually when that happens, this is what happened in 07, 08, like the transition from 07 to 08. They started pulling back on credit, on lending, because they didn't like what they saw. And that's what really started it. Because, consumption keeps going just fine as long as people have endless amounts of credit. And as soon as they start pulling back, it's like a brick to the face. And you couple that with the student loans coming back, just that for the consumer is very painful. And you have to remember, who is this consumer? What do they look like? Well, they look like a generation of individuals that has never seen a pullback in the past 15 years, 14 years. So they really don't know what it is to be unemployed, have difficulty getting a job, having the credit pulled, having to make difficult choices. This will be their first time, I think, interacting with this. And I think when we look back on this, it's actually, when everyone says, oh, soft landing, no recession, I think they'll look back on this and say, duh, everything was right in our face. Of course, we're going to have a nasty recession. And that's usually how it goes. But everyone's in denial right up into that point. And I'm really excited that everyone has called it I was wrong, it's a soft landing, no recession, none of that. Jobs, look, there's a we'll never have jobless again. There's just so many jobs available, blah, 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 blah. These are all the words that are said at the tops.
Right. And internationally, do you have a viewpoint, Mike? I think, in Asia, there's a couple of names that look pretty interesting. Singapore and Malaysia. And in Europe, Italy and Germany. Italy was last super strong, but kind of topish. And Germany is definitely topish. So Germany is almost about to roll over. Yeah. So any viewpoints on international roughly?
Well, I mean, you mentioned the TGA earlier, and Yellen got the call from the White House and said, told her, you're going to do whatever it takes to lend max liquidity all the way to the election. And so what she did is that she is in the process of financing the government on 30 to 60 day paper. And I got to tell you, whoever wins this election coming into 25, I mean, they are going to be walking into the nastiest situation with, $1 trillion of CRE that has to be refied. A lot of it's underwater. That's going to be going bad. The government is going to be loaded up on totally short-term paper, which is a huge threat and risk. And then I assume the SPR is going to be completely depleted. This White House will deplete all of our reserves in order to get the smoothest, best year possible for the election, and will not give a crap about what happens after it. So
that's true. Then I think the bearish outlook on equity must be tempered, no? Because if the government is all set for 2024 election to create fiscal policy.
But they can't do that. They can't do that. They can't do fiscal policy moves because you can't get anything through the House.
Correct.
And this, I went through the SAVE Biden plan for student loans, and this is just another rewritten rendition of changing the lending rules in order to accelerate forgiveness and loans. And the Supreme Court's going to barf all over this. So that's
so no fiscal stimulus,
stimulus,
but monetary could be a possibility,
but only very minor. Like what the Treasury has done is very minor. It's been major for the very short term because it acts like an Operation Twist,
right?
Where you're funding on the short end and you're not funding on the long end. So that should promote lower interest rates on the long end. However, a funny thing happened on the way to the BOJ, where the BOJ said, we can't take this anymore. We have inflation and we have to get rid of it. And so they're hiking their 10-year from 50 bips to 100. And people say, hey, that's not that much. Well, it is when you have tens of trillions of dollars of loans that are short that JGB and long everything else in the world. So that trade has to come off, has to be unwound, has to be rewritten. And
I'm glad you brought up JGB, right? So a lot of CRE has been stuck to the either Japanese investor or the insurance companies in Japan, as well as insurance companies here. So I wanted to tie these two things, right? The CRE mess along with the Japanese EU control policy change or outlook change as well. Those two things set us up for a pretty interesting August, don't you think?
No.
Especially from a choppiness perspective.
Well, I mean, choppiness is in real liquidity is going to get sucked out of the system at an all-time high when retail is all in long calls.
Right.
If you mean choppiness as in doom, yes.
No, I didn't quite go towards doom, but maybe 5-7% correction for sure.
Yeah.
Maybe we started at like the 42, 4300 mark.
I'd say that, but when I take a look at so many of these companies that are reporting negative volumes and coming right off of positive pricing, and all the models assume 5% more pricing moving forward. I mean, if you walk in with 2% negative pricing and 2% negative unit growth. I mean, you're talking about a -4, and that's coming off of a positive 5, 6, 7. I mean, that's a massive shift and not just to revenues, okay? That's a huge shift to the bottom line because you can't adjust your costs fast enough to catch that. And the same is said, you couldn't adjust your costs fast enough to adjust to that pricing increase, right? Where you got a lot of earnings out of that and poof. I mean, I'll bring up IDEX Laboratories. That's a diagnostics company for pets, all right? And it trades at like 60 times. It's crazy expensive because they're nearly a monopoly, and they put up 8 or 9% pricing for this year, but they don't have revenues to match that pricing. The actual units are negative, and the street assumes 5% more pricing moving forward. And when you're trading at 60 times and a crazy revenue multiple, it's just like, my interpretation of what's going on is that nobody is paying attention because nobody's doing these models. Like, nobody is doing these models. Or the mix of investors has changed. So the hedge fund guys are still doing the models, but the people in charge, meaning retail, don't, and they don't know. They buy stocks that go up. They also sell stocks when they go down. We'll find out tomorrow if the break happens. But all indications for me are that break is going to be now, and this is pretty much when I thought it would be. I thought it would actually be a little bit sooner, like in July, not at the end of July, but I thought that we would see the pricing power run into huge problems right around mid-year, and here we are.
And even in August and September tend to be a bit on the negative side, leaning. So approximately 62 to 72%. Chances of a negative month, just from a monthly return perspective, anywhere between negative 2.1 to 3.5%.
Mm.
So, yeah, I think we have a good setup for the choppiness to prevail. May give us opportunity for buying some good businesses, but also opportunity on the short side if one is trading actively. So on international front, Mike, what's your opinion on the Asia side, Singapore, Malaysia, and Rob? If you have an input from the quad perspective as well, that'd be great.
So on Asia, I think that China is entering at least a 30-year malaise. So
similar to Japan. Wow.
No, it's not similar to Japan because China is a police state with fake data and fake news. So, if Japan, how it's doing one way or the other, we actually are aware of it. But China essentially has worked in earnest to erase all data that we can get. And they'll continue to accelerate that. Look, the youth employment in China is at least 18%, maybe more. And my folks on the ground, it's just outright depressing. And this is really what happens when you have a CapEx economy, and that's what China has. They have exports and they have CapEx, and their export world is running into a big problem so far as wage growth, and we're all aware of this. And a lot of companies, including Apple, has been unwinding their exposure to China, moving it to India and other places, and many companies are going to do that. China's in serious trouble. And part of the reason, the biggest reason, is it's a command economy. They choose the king. They are the kingmaker of You will make the best chips. You will make the best cars. You will, they're essentially all state entities. Everything is, because the government can walk in at any time and tell you how to run your business and who's going to run your business. So the probability of China ever getting anything right so far as technology and innovation is near zero, unless.
Well, maybe that's why they're getting ready for Taiwan, right? Because did you see that recently? The premier fired his 2 generals from that secretive army unit, Rocket Force, PLA's Rocket Force, which ended up becoming a big deal, because now that kind of further puts odds of their chances of invading Taiwan a bit higher as compared to before.
I think the probability of China invading Taiwan is extremely low. I mean, the reason why I think it's extremely low is because China can't tolerate a global boycott of China without having a fiscal catastrophe. And they're already circling the bowl of fiscal catastrophe because they can no longer pull the lever to simply build more empty buildings, because they need hard currency to do it. They need US dollars, and they don't have it.
Yep.
So
dollars, euros, everything.
Yeah, so I don't think they're going to do anything. They're basically going to continue to accelerate the clampdown on the public and the control on the public, so that if there is any unrest, they can control it with their police state. And that's the biggest issue they have going now. It's not about being the economic giant. It's about the Politburo simply not having their head on a spike. And that's what they're really fighting for. I mean, think about it like this. China, over the next 30 years, is going to lose 30% of their population due to old age and death and no babies. So at the end of that, you're talking about hundreds of millions of vacant residences and homes and buildings and highways and subways and bullet trains in China that are all crumbling because they were built to the lowest imaginable standard to begin with. That's what China looks like 30 years from now. And because they're a kingmaker on innovation, command economy, they can't actually innovate because they don't let entities fight it out and figure out who's going to be the best producer of XYZ. That's not how they work, especially with Xi. So they're just not going to be able to innovate, and it'll just be worse and worse and worse and worse moving forward. Real Soviet Union shit. And that's what it looks like to me over the next 30 years. So Japan is in huge trouble because of this. That's their biggest trading partner is China. So it's, and I realize I'm looking very long and very far, but it has started already. And their infrastructure there is just crumbling. They made this all on the fly over the past decade or so. And, what is it going to look like 10 years from now? It's going to look like a disaster.
Hi, I'm Keith McCullough, and I wanted to introduce you to my favorite product at Hedgeye, the Macro Show. Why is it my favorite product? Well, it's my show. I do that every morning. If you want to get ready for the market day, you want to contextualize all the data, you want to make good decisions, then this is what you should be watching. It's a repeatable process that you can deliberately study, measuring and mapping time series to time series of data. So it's not going headline to headline and getting whipped around. It's actually being so much more dispassionate about it and making good decisions that are data driven. So we'd love to have you on our team. Come join us.
Tune in weekdays at 9 a.m. Eastern and on demand anytime. Go to hedgeye.com/research to subscribe.
From Asia and our side, I touched base on this earlier, but basically, EM ex China does look quite good. We're long of Brazil, things like Brazil. But in terms of like in Asia in particular, South Korea not only has a great signal strength, but also is backed by basically 2 upcoming quad 1s, then a quad 2, and then a quad 1. So they got a very, quote unquote, rosy next 4 quarters compared to, especially if you're looking at the U.S., which is quad 4, quad 4, quad 3, quad 3. So you got South Korea. Taiwan actually looks pretty good. We're not long with Taiwan at the moment, but they've got kind of 3 quad ones on the horizon. And but yeah, so South Korea, Japan.
How about Malaysia and Singapore?
So Malaysia actually has 2 more quad 4s on the board, and then or like upcoming, so Q3 and Q4, after having 3 quad 4s the last since Q4 2022. So Malaysia doesn't look that great, especially from a quad outlook. India looks good. So from an Asia standpoint, India, South Korea, Japan, those are, we've recently added Indonesia and the Philippines as well. But those Indonesian Philippines could be a bit more of kind of like a trade versus a bit more of a longer term, potential outlook. Call it, again, not quite on Mike's horizon there, which I think is probably a bit more like 2 to 3 years, but certainly called the next 9 to 12 months. South Korea in particular, I think looks really good, and Taiwan too. The signal is starting to pick up. It looks like in Taiwan. Big pullback today, obviously, but in general, kind of certainly. I see what you're seeing in Malaysia there, trend in the last since July, but I don't think from a signal standpoint, buddy. But I don't think I would be surprised unless the data starts to roll in differently that's going to continue or have much legs.
Got it.
Yeah, India, and then Brazil. As I said, Brazil, Chile actually has a really good. They have 4 quad ones from Q3 out to Q2 on the board. I've actually looked at that. What's that? That's ECH, right? It's Chile, yeah. Oh yeah.
Yeah, ECH. I don't drink much. It's not that liquid.
No, it's very, very illiquid. I just want to pull it up. Yeah. But it's that's a good looking signal actually. That's kind of yeah. So we're in agreement with Mike in terms of China. We're basically short of China, including Chinese real estate in Hong Kong, EWH, FXI, and CHIR. So those are kind of have those on the short side versus long in terms of South Korea, Japan, Philippines, Indonesia, and India.
But we have a couple more. So
I was going to say we got a couple guys that jumped on. Mike, I had 2 questions. So before I go to them, let me. I see a question on Twitter in regards to despite the recent move, do you expect a bull or bear steepener into year end? So I'm going to come back to that, Mikey. But I have a question for you. Actually, let's answer that, and then I have more of like a portfolio management question, a little selfishly, to be perfectly frank with you, because I just want to learn from master. So just kind of, but I'll come back to that. So do you have any thoughts or kind of expectations in regards to a bull or bear steepener into year end?
Oh, that's a great one. Well, the short end of the yield curve really can't move for the near term, meaning the very short is in sub 2 years, sub a year. But I think because of the activity of what's going on with the BOJ, we're probably going to see a steepener occur, and where the 2-year yield down and the long end up. And that's really going to be that'll be a very, very, very painful disruption, by the way. Just like our treasury has to finance so much, and one of the vehicles of leverage to finance that treasury is the BOJ and their yield curve. And if that cost to finance is going up, and I realize for many of your listeners here, this might be a little difficult to understand, but in order to find money to buy treasuries, you can go out there and short the 10-year JGBs, and now you got the money to buy the treasury, and there's a yield discrepancy. The 10-year over there was 50 bips, and the 10-year over here is 400 bips. And you lever that up 5 times, and you have a nice return. However, when that yield starts going up as it is for the JGBs, that changes the entire borrow rate calculation. And it takes down the leverage. And that means you have to sell your treasuries at a time when our government desperately needs to fund, probably next year, a $3 trillion deficit. So these are really, really, these are disgustingly large numbers that have never, ever, ever, never, ever occurred during a full employment environment. And it may not feel like it right now, but the fiscal policy has the foot to the floor at a moment of full employment. This is setting us up for some of the most unbelievably awful comps at some time in the not too distant future. Or it's going to set us up for much higher yields. It's going to be one or the other. And I don't know which way it's going to go yet, but I'm certain it's going to be painful no matter what happens.
Yeah, I think it's been pretty interesting price action, Mike, to your point, in terms of, basically across the curve, right? Especially the longer end, though. I mean, the 10 years up in the last 10 days, it's up basically about 6.5%, and the 30 years up about 7%, whereas the 2 years, relatively flat. And that yield curve's come in from, in the 10 minus twos, has come in from, sub, what it closed at? It closed at basically 100 minus 105 bips, call it 104 bips, to basically minus 80. So it's been a massive kind of massive 10-day move, and even just in yield curve to your point in regards to that component. So it's been it's been very, very interesting, and that Japanese 10 years all the way back up is up to it's about 644 as of right now.
Yeah, so they're letting it live very aggressive.
Yeah. And it looked like they kind of put a little bit of a lid on it at the 60 bips number, but it seems like they're going to let it go.
To realize, the headline was that they put a lid on it. They intervened, right? And so told me, they did 300 billion, and I was like, yeah, that was 300 billion yen. That's right. $3 billion of intervention. That doesn't even count as a fart.
Exactly.
That's why I was like, okay, they're like, they need it. And I'm like, no, they don't.
Yeah.
And
no.
So when you take a step back, all right, and you think of real world issues here, okay. So lending is fading pretty aggressively. The cost to borrow money to buy a used car, which is still overpriced, but collapsing, by the way, that price is collapsing, is 13% on average in the U.S. How the hell can this end up going well? I don't mean just for autos. I mean for everything. This is what everyone's missed, is that the nasty impacts of an inverted yield curve are delayed. And we've been in this now for over a year. For this to have an impact. And I think we're going to see it starting next
year.
Usually.
Yeah, and Mike, usually the inverted yield curve is the one that causes the recession, right? It's not just a harbinger, it's actually the reason for it to happen. Campbell Harvey was one of the first ones who had done some research on this about 2-3 decades ago, and then he went on to do other quant research elsewhere. But pretty much, the inverted yield curve by itself causes the slowdown, and that's the goal. That's how the Fed tries to control or rein in all the inflation.
Yeah, and the hard part when I look at it is that walking into negative pricing power, walking into a slowdown in demand, walking into negative unit growth, walking into the earnings models, running into a huge problem. And that huge problem can only be solved with laying people off in order to try to keep earnings where they are. And when you take a look at the trends for the jobless claims and everything, we're right at that precipice of where they historically start to rip. We're right, and then this is what Gundlach would say, and his model, just like my model, said it would be around the middle of the year when it should take off. And here we are, and all of the things are happening where it's ludicrous to borrow money to pay for an overpriced car. And you just go on and on and on. You know, Cap One and Discover are pulling back. You know, the lending survey, so lending, pulling back on lending. All of these things are just bullseye, bullseye, bullseye. It's exactly what you would see. And the one thing that makes it epically painful is that the consensus is no recession. We're going to be fine. We're just going to motor right through this and nothing's going to change. We're good. And you know why Wall Street's saying that? Because they have a shit ton of paper to sell everybody. That's all they care about. And they'll say it till they're blue in the face every single time. And if stocks go down, it's never been a better time to buy. You always get in there and buy that dip. If jobless claims go up, you say, oh, this is just a healthy, shallow recession, right? But the problem is that we have $2 trillion plus of commercial real estate to refinance, and nobody can refinance it because they're negative NPV projects. I'll give you a really nice example here. You know that restaurant, I was looking at it today because I reported Cake Factory. Cake Factory doesn't actually make much money at all, very little. And in 25, Cake Factory has a $375 million convertible that comes due. You'll laugh when I tell you what the interest rate on their convertible is. 0.375. Guess what's going to happen in 25? That number's going to be 10, and they'll be they'll be insolvent. And there are so many companies and REITs that look just like that. And I don't mean so as in like 20 or 30. I mean hundreds. So it's nauseating, but look, and what would make this such an awful setup is that we have like the biggest bull trap ever, driven by a touch of liquidity, wildly overzealous retail who all own options. They're in options accounts now, and they're levered 100-to-1 in these options accounts. And you know, and when you take a look back, you look at this, you're like, there have been so many unbelievably stupid things that have gotten really, really big that don't make any sense whatsoever. And we've grown accustomed to this. And it's all because of wild government spending that has put dollars in everyone's hand. Crypto serves no purpose but for speculation. Remember NFTs? NFTs was the next big thing. We don't even talk about NFTs anymore. Right?
I saw an article I saw an article the other day about the NFT that who was it? Oh God, I can see his face right now. He was the YouTube YouTuber that turned into the boxer. What's that guy's name? Doesn't matter. But basically, he paid like $600,000 for some NFT, and it's now worth like $13,000.
Yeah. Good luck getting that number.
Yeah, no, I know.
Yeah, right.
All right, so we got to go. So, Mikey, we got Taylor. We got a couple questions out there before John. They're going to come to you first, bud. But just a little bit of housekeeping here from a Hedgeye standpoint. We got our first regional event, Hedgeye regional event since Hedgeye Live, where which was the last time, Mike Taylor, that I saw you in person, bud. So that was back in May. But we got Hedgeye Live coming up on September 12th. I've pinned kind of some details in the tweet and a link to it up in the nest. Just a couple of things here in terms of, again, it's September 12th in Las Vegas at the Green Valley Ranch. The $250 discount on the tickets ends on August 15th. Jake Paul, sorry, Ben K. Yeah, thank you. Jake Paul, that was the guy. Anyway, so back to the Hedgeye Regional. $250 discount on the tickets ends on August 15th. So you got about 2 weeks. The room block is almost full. So do you want to if you want to get the discounted rate on the rooms, really should try to get that ticket soon. The first choice, again, for dinners, they are filling up quickly, but there's some great accommodations. And if I may say so myself, the Salem and McGrory dinner is going to be awesome. And then we got McGough and Jordan, Felix Wang, and Joseph and Avi Joseph, and then Howie, who's got his new book, the forthcoming, the sequel to the forthcoming, Fourth Turning, for Neil Howe and Brian McGough, and then Ben Skyver and Friedman. So again, that's Vegas, September 12th. With your ticket, you do get 3 months of free Sector Pro, which is worth a value of $675. We are doing a couple fun events the day before, so I'm coordinating a golf outing. If everybody wants to come a day early, that would be on the 11th. And then there's also an opportunity to do a helicopter ride down to the Grand Canyon as well on the 11th. And then I'll also be hosting a weekly notebook review live on the 13th, the following morning after the conference. So should be a lot of fun. Notebook review, Hedgeye Regional in Vegas. We've done LA, Dallas, Miami, and now out to Vegas. Should be a lot of fun. But Jonathan, the floor is yours, my friend. Thank you for your patience.
Hey guys, thanks a lot. Thanks for taking my question, Robert and Mike. And Robert, thanks so much for your being gracious with your time. I get two questions, Mike. The first is I just got out of work, so I haven't had a chance to take a look at the information released today about how they're going to start issuing either bills versus bonds. And I just was wondering if you had any thoughts on that in terms of it seemed like preliminarily they were going to be going more higher concentration of bonds versus bills, but just didn't know what your thoughts are on that. And the second question is in terms of the outlook. I mean, I'm really very much aligned with what you say, but I was a little surprised, with the last GDP print, Hedgeye model basically was just a little bit different, or quite a bit different, only because of the government spending. And sort of my threshold question is kind of like if the government just intends to spend for the next 18 months and pump GDP, it seems hard to get sort of constructively bearish. So I didn't know how you sort of reconcile those two ideas in your head.
Well, a lot of this excess government spend is going into Build Back Better. And this is actually... It's long. These are going to be really long to implement, many years to implement, even when they dole out the money to folks. It's not like instantaneous. It's years of planning and then execution. So it will be a meaningful tailwind, and it's nice, but it's going to be smoothed over many years. So, and I think about how much they're spending, but there's two things that you have to remember about the government spend, because it's not exactly, it used to be a magic wand, and then all of a sudden it's not. Because this year they're going to have to spend $1 trillion on paying the coupon on that debt. And next year it's probably going to be about $1.6 trillion. And they're not going to have the receipts, I don't believe, because of a recessionary environment to pay it. And so they're going to have to borrow more. And what we may be seeing is a touch of a crowding out of commercial lending, crowded out by the government. So, you always ask yourself, and it's never really come to fruition, where, well, it doesn't matter how much the government borrows because there's no consequence for it. I mean, look at Japan, for instance. So, and that worked for Japan because they could basically take their entire yield curve to near zero, so it didn't matter until they ever got any inflation. And then it turns into an absolute catastrophe. This is why Japan never wanted inflation, even though they said that's all they want is inflation. They don't want inflation. That will cause the biggest epic debt bomb that they could ever conceive of if they had inflation. The U.S. is the same, where now that we've had a sticky problem here, now they have to start paying for it, and it compounds over many years. This year will be another 600 to 700 billion. Next year will be another 600 to 800 billion. And I'm not really sure what yields do at that point moving forward. But, they run into a gigantic problem where the government, the general receipts that come in, the general tax receipts that come in, they have to go out to fund that coupon rather than paying people for government programs. And as you know, so much of the treasuries, let's say 45% of those treasuries are owned outside the U.S. Those are dollars in coupons that are not going directly into the U.S. GDP. They're going out. Nobody calculates that crap. Neither do I. I just do it on the back of my, notebook. So what I'm really looking at and focused on and thinking about is, what are all these employers going to do with their employees as pricing goes negative and they can't make the numbers? Are they going to hire more people, or are they going to let go of more people? And that's the question. So, but that's an incredibly valid point that you have about the government largesse keeping everything afloat for just that much longer.
Yes, Mike, I don't know if you saw, but in the CVS press release, or might have been in the queue, but basically in their notes they talked about leveraging AI. But they leveraged AI and fired 5,000 people. So I don't know what those 5,000 people.
Can I tell you that? Can I translate that for you?
Yeah, go right ahead.
We fired 5,000 people.
Yeah, listen, I'm just giving you the reason. I'm giving the reason that the company used, but yes, they fired 5,000 people, and so it's gonna be interesting. All right, yeah, good question, Jonathan. I really appreciate it, but I'm gonna butcher this, but Titos Capital. I'm just going to call you.
I just want to tell you, I kind of got a hard stop in about 9 minutes.
Yeah, I was going to say, we've been at this for like an hour and a half. So,
we have? Holy crap.
Well, not quite. I mean, it started at 8, so it's been an hour and 20. But yeah, 9:30. Auntie, the floor is yours, buddy. You've been waiting for a while.
I mean, with respect to Mike's time, I'll be crisp. One of the things you said earlier was that I think 2 major credit card issuers are pulling back, right, in terms of perhaps, various lending capacity to certain credit scores. What was interesting, though, we saw that SLOOS report, right, on Monday, and it talked about demand waning across sort of all areas as the tightening continues. But the one area that they didn't see a drop off in demand was actually the demand for credit card, capacity. So how do you bring that together, right, with the idea that the highest interest rate area is seeing the most demand, and we're at the highest interest rates ever on those credit cards that are being issued, and that's where the highest demand is. Yet, you've got that collision course with these issuers.
Yeah. How old are you?
I'm sorry?
How old are you?
I'm not a young guy.
You sound sprightly. That's a compliment. Well, you remember what it looked like in 07, 08 is that when the going got tough, the lower end needed more and more and more credit because they're playing the credit card musical chair game. Look, these people don't want to lose their car. They don't want to get it repoed, so I need another credit card so I can start, keep making payments. I think that's what's going on.
Okay.
And it'll accelerate, that demand will accelerate as soon as they also have to pay student loans.
Yeah. One other thing that came up earlier was the yield curve inversion. And I know both of you were talking about that. Just a little context, which I find interesting. You might find it too. Campbell Harvey was brought up, right? Who actually was the one who did the research on that years back. He's a Duke, professor. And anyhow, the point is Campbell Harvey actually at the end of last year, really the beginning of this year, came forward and said he didn't think his indicator was actually accurate this time around.
Right.
And then he actually 180'd at the end of April. And he said, no, my indicator is correct. And in fact, in the last week to 2 weeks, he's actually been on the airwaves saying we will have a hard landing.
we're going to have one hell of a hard landing because pricing is going negative. And just read the transcripts. I mean, they're all saying it, but they won't say it. They're saying discounting. Discounting means sequentially negative.
Hi, Robert McGroarty here, Director of Subscriber Development at Hedgeye. Hope you're enjoying our podcast. Start generating alpha with our suite of Sector Pro investing research products. Dive deep into retail, industrials, technology, and everything in between with exclusive access to the sharpest analysts and actionable ideas on Wall Street. Go to hedgeye.com/research to subscribe. Enjoy the rest of this episode.
Yeah, Yum China. Do you see that Yum China? So Howard Penny talked about this the other day in terms of outside of basically the festivals and what have you, right? The Yum China they increased their promotions. So Mike, to your point, right? They increased their promotional. They increased their promotional campaign. It basically means that they discounted their pricing.
That's what we're going to hear a hell of a lot of, and everyone will be excited. Oh, the unit growth will make up for it. So let's review the unit growth just for a second, and we'll use Ford, right? Let's use Ford, right? Because Ford put it out there. So we're cutting our truck prices by $10,000. All right, that's for starters. All right. So what do you think Ford makes on a truck? Right? Let's go crazy and say they make $20,000 on a truck. They cut it in half, that profit margin. Don't they have to double their volumes to maybe break even? What's the probability Ford's going to double their volumes? 0. There you go. There's your. They're going to miss them. So
whiz.
And that's how it works. And so what are they going to do? Exactly what they said. We're going to fire people. I'm sorry, we're not going to fire people. We're going to implement more AI. That's what we're going to do. And we're going to be working with our union workers to learn how to use AI, and then we're going to fire them. So that's what's happening. That's like, I'm reading, dozens of transcripts, and it's just one after the other, that reads like that. And I'm just like, oh my God. So they haven't announced that they're firing a lot of people yet, but you can see they are drawing the whiteboard on what to do if pricing tanks. And they're thinking about it now. And of course, they're going to say AI because that'll keep the stock price up. Unless NVIDIA misses. And then nobody can say AI because that means your stock's going down.
Yeah. They said that I think they just announced their quarters on August 23rd, I think it is.
Yeah. Well, AMD said everything's good, but not 3Q. That'll be bad. So it was up 8% in the pre and then went down 15% reversal intra morning. And because everyone, the retail guys, it's AI, and everyone's jammed in there. So
yeah, that's it. So just along those lines, Microsoft, just from a signal standpoint, week over week, from what we were talking last week, it's moved to bearish trend. So that's kind of one of a few really one of the first breakdowns in terms of something that had been bullish and had been bullish trend for a number of it's been bullish trend for quite a while. So
what bearish trend means? It means it broke the 50 DMA.
Well, yeah, your good mate Keith might say otherwise, bud.
No, I love Keith. I absolutely adore it, and I think your product is by a mile the best research product on Wall Street that's ever been on Wall Street.
Well,
and I'm even insulted to say that you're on Wall Street because we hate that street so much.
Yeah, that's why we're
the new Wall Street.
Right. Exactly right. So, I know you got to wrap up, bud.
Okay, guys. So I can take one more question. All
right, so we'll go to BJ, aka Don't Fight the Fed.
Hey, Thanks, Rob, Mike.
Of course, Vijay.
And Manu. I noticed you guys were discussing about China, and Mike is obviously negative about China, and so is Hedgeye Nation as well. I saw a lot of noise on FinTwit, and some look legitimate that stocks like Baba and many Chinese big tech and are quite attractive for short to medium term, just because the Chinese government is trying to support their platform company and this and that, and many things are coming in news. So with all that backdrop, when China is trying to stimulate and they are not able to, but stocks like tech stocks like Baba and JD at quite attractive valuation if you believe the balance sheet. And so what do you guys think about it? I'm not in any of these stocks, but any input opinion? I know the answer, but still I wanted to get confirmation. Thank you so much for your time.
Yeah, I'd just be very like, for instance, if China is going to stimulate, and that would be the thesis for all these stocks going up, you have to look at exactly how much and what they're doing. Because
I saw something this evening, Mike, that they're going to stimulate by doing like festivals, like food festivals. So they're basically doing almost everything. They're trying to stimulate in ways.
It's because they can't.
Without directly giving money to like the people.
It's because they can't. It's not that giving money. They have to. The only way that China can stimulate is building more infrastructure. That's it. That's what command economies do, because they can't do anything else, and they can't do it because they don't have enough dollars to import the cement to do it, and the steel or whatever. So this is the doom of command economies, that you only have stocks go up because the government says so, and they only go down because they stop saying so, or they just say less. And I don't trade China particularly at all, because the correlations are going to be extremely high. And the accounting, like, what do you own? What do you own? You don't actually have rights. So I skip China entirely. I only watch it because everybody has a hook in it somewhere, and it's a big piece of somebody's business. Look, you have to ask yourself, why is Apple there? Why is Tesla there? Why are these business interests in China at all? Why does China let them stay in China? It's because China needs them. If China has Apple in there and Tesla in there, because of that, and there's earnings being derived from that. Yes, they can't get their cash out, but at least on a pro forma non-GAAP cash income statement, it's real cash then in that case. But no, they can't actually get it out. However, it lends China a lot of influence at the White House, because they have their hooks into Apple and Tesla and all that sort of stuff, and that's why they're still there. But I think it's going to become a more diminishing piece.
Yeah,
got it.
Yeah, Vijay. I mean, I think to answer your question in terms of like, are there going to be individual winners and kind of like losers? The answer is yes, right? Just like, even if generally, we are bearish China, right? There, the Felix Wang, our Chinese sector head who covers China, he's got. I think Keith said it on the call either yesterday or today, that two of his top 10 like individual longs are out of China. That would be EDU and MNSO, so USO Group and New Oriental Education. So in terms of like longs, I've seen the same similar chatter, Vijay, in terms of like Baba and people, just again, be cautious and conscientious of Fintuit. But when you got a Chinese analyst and the sector head who's been very, 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 very good on both longs and shorts on individual names, And yeah, so like JD, for instance, is on his best ideas long list, along with ZH and Tour and DD, right? So those are kind of some. ZH isn't that big, but JD and DD certainly are. So I mean, you could do that, and then kind of on the short side, he's got Data and PDD. So you can kind of do a little bit of and even Billy, that's another relatively big one, right? So you can kind of do a little bit of a long short pair off trade. Or just do those individual those individual names, like EDU and MSO, or even just a JD, right? Do long JD. And just remember, like, your longs are twice as big as your shorts, but you could do long JD, short EWH or short FXI, right? And kind of get the larger complex on the short side. So kind of a bit of a pair trade. I think Wiz loves his pair trades and kind of having, the dichotomy and stuff like that. So that's one way of thinking about it, VJ. But of course. But generally speaking, we are certainly, short of China.
And one quick thing I will add for Michael and for everyone listening, I noticed the MedTech like Abbott Lab and Shockwave Medical and all those medical device company, which Michael knows more than anyone here. They are showing weakness since last couple of 2-3 weeks. I don't know if it's general market or it's because of those weight loss drugs, Ozempic and Mounjaro, will reduce their bread and butter cardiac procedure and cerebrovascular interventions. So I don't know. I just noticed the weakness in that medtech sector with good companies like Abbott and Shockwave.
I've noticed it too. Pink was not involved in that, but others, and got hammered pretty good in the past week. And that really has more to do with what trend the Wiz is saying about rotation. And it's a huge factor rotation that's underway of essentially selling everything that's up. And at the same time, over the past week, up until the past couple days, you've seen shorts go up too. So you've seen good ideas with good prospects and good delivery and a good chart break down and crash lift. And that's been hedge funds unwinding, taking down gross. And it's happening everywhere. This usually precedes a meaningful sell-off.
Got it.
Especially when it's this extreme. So a lot of those companies are in fantastic condition and have just taken a 10, 12, 15% whack job literally in the past 3 days. And, this is part of that rotation. I think it is just the beginning of that rotation. And I have acted and moved my feet accordingly because my job is to have, meaningfully positive returns in pink versus my benchmarks and my competition, which largely is Fidelity and T. Rowe Price.
So, Mike, on that front, Gavin had a question on Lilly. You have a viewpoint on Lilly, given all the factors that are in play at the moment?
Factor-wise, Lilly is at risk, okay, only because it's been a big winner for like 2 years.
Right.
That said, the pharma group will be, because remember, when people rotate out of tech and they go into pharma and Walmart, stuff like that, they don't know what's in pharma. They have no idea. They just buy them all. So I'm not too worried about that factor part for Lilly. In addition, in my opinion, Lilly probably has the category killer in the weight loss drugs.
Yep.
They have the best drug, and it's not approved yet for weight loss. So it will be shortly, and I also think that Medicare is going to end up covering these weight loss drugs potentially around year end, and that is going to be absolutely gigantic. This could be, I'm not joking, like a $40 billion category.
Yep.
And Lilly should honestly get more than half of it. So net, I'm bullish Lilly because I don't really see a mechanism where they aren't the winner here. There's no drug on the horizon that's going to be competitive. I mean, they're all competitive. It's just Lilly has a better drug, and it's marginally better, but that's enough. That's enough to make a real difference with the doctors when they have to choose one. They're going to choose the one that is clearly better.
Are you worried about pancreatitis and gastric paralytic effects, which I am hearing not very commonly but anecdotally?
Oh, it happens. It happens. These are in the label side effects that certainly are an issue. But when you take a step back and you look at these rare events, and at one point the media will get on it and say, oh my God, look at all these terrible things. But once we start seeing the outcome studies where people aren't dying from heart attacks anymore because of this, they're not becoming insulin dependent type 2 diabetics. I mean, this is going to have a profound impact on everyone, from everything from liver to kidney disease to diabetes to cardiovascular disease, potentially even the onset of Alzheimer's eventually. So I think it's and remember, these drugs aren't new. This class, the glucagon-like protein 1 class, GLP-1 class, has been around for years.
Yep,
in millions of patients. So it's really just new that it got enough data where we could stick it in people for weight loss. So
short all restaurants.
Short haul restaurants. No. There are. So I think that we're probably going to see a slow, because of this drug, especially if it's widely accepted through Medicare and so forth, we're going to see a slowing of onset to severe diabetics that have to go on renal dialysis. We should see that slow. And if it just slows a couple percent, and I know that's exactly, and a couple percent will have a profound negative impact on DaVita's P&L. So those are things to keep in mind. We'll probably start. I don't know exactly when we'll see it, but I'll tell you when we do. And it should not be too far off to see that growth rate start to abate, especially if it gets covered by Medicare, because then all the other private payers are going to feel obliged to also cover it. And
that's a great point.
Yeah. And that'll be a very, very big deal. But the class is very well tolerated, and the effect is profound. I personally know probably a half dozen, more than that, people on this class now that have lost 20, 30, 40 pounds. So, and that's great. That'll change their life. At least it'll change their sex life.
And with that, my friends,
all right. On a high note. Hey guys, all right. Have a great night. Talk to you.
Hey, Mike, thanks very much for coming on.
You bet. Bye-bye.
Good night. Bye, buddy. All right, so Ben, you had a question. I don't know if it was for Taylor or not, but I got a couple more minutes for, if you got any questions for Wiz or myself. I probably got another 10 minutes in me. Thanks for that, Jake Paul. That was exactly what I was talking about.
I know. And
it's good to have you back, Ben. Yeah, it's been a while.
It makes me a little sad that I even know who that guy is.
Well, here's the problem. I could literally picture his face, and and I knew he lost. I think he paid like 600. I think it was like $600,000, right? Wasn't it?
Oh, it was way more than that.
I forget what the article was, but I know it's now worth like basically in the teens. But
he has that is a man with multiple grifts. But no, again, like just when you think about the most punchable face that just think Jake Paul. That's all there is to it.
You're getting a little off track though, so let's bring it back in.
the big thing, and I wanted to talk to Taylor about this before he bounced, but in my very humble opinion, every auto stock is a short for the next 2 years. And I can like go into an entire tirade about that and why that's going to be a fact. But it ultimately comes down to cost of ownership. Like, I still have an open email with Daniel DiMartino Booth, who I know Hedgeye is a fan of, going back to like November of last year, where I finally got a hold of her, and then I just kind of like froze up like an asshole because I was like, oh God, I can finally talk to you now, and I don't know what to say. But I can talk about that pretty easily here. So it's total cost of ownership, TCO. And we have Rod in here, and Rod Alsman is a very, very well versed man in the owner and operating costs of vehicles.
Yeah, especially trucking. I believe he was right.
Especially commercial trucking. Yes.
Yeah.
But he can also
use it. Yeah, I think he was a writer, right? Yeah, Rod.
Yeah.
I love Rod. Great. Big friend of the program.
Yeah, Rod is offensively smart. But on the retail, like on the purely retail side of things. So again, like I have special insight into this because again, like I'm somebody who works on cars for a living. So I get to see this stuff day in and day out, nonstop, every single day, 24/7, 365. Like that is my life. Unfortunately, I am currently transitioning into finance. I have a Series 65 scheduled for late August. Fingers crossed I pass it. But
that's awesome. Congrats.
I mean, don't give me congrats until I pass it. But it's so like I'm riding that fence, but seriously, so automotive is completely fucked with a capital F, in my opinion. Like there is nothing good that's going to come out of Ford or GM or Stellantis Chrysler or Tesla over the next year to 2 years period. The only companies that have approached this with any sort of intelligence is Toyota and Honda. And that's it. Because they're like Toyota and Honda are currently slow rolling production because they're like, oh wow, we're getting these really improved margins on our sales because people want to buy our cars. So why are we gonna, ramp production into a high gross margin situation? They're not going to do that. That's not going to happen. And this goes back to 60-day rolling inventory. Cox Automotive puts out great reports on this stuff. You can look it up, read it for yourself. But they summarize the 60-day rolling inventory for various car manufacturers. And Toyota and Honda are the two companies that are really slow rolling production right now because they want to hold on to those really high gross margins. And I expect them to keep doing that. It's basically like all your tier one sort of Asian manufacturers for cars that are slow rolling that manufacturing. Like Nissan's fucked. I mean, it's a crappy car. But they're kind of like barreling into higher production. Same thing with Hyundai. Hyundai is good in some ways, depending on like what kind of car you're buying. But as a whole, like the automotive industry is not in a good place. And I've been talking about this for a long time, because we saw this, meteoric rise in used car prices over the last 2-3 years. And that is like, as everybody should know, those are naturally depreciating assets. And we saw the most recent reports from Car, which is Avis Rental, and Hertz, Also, by the way, Hertz is currently speed running their second bankruptcy. They should file sometime in 2024, early 2025. But like, cars are just naturally depreciating assets. Like, that's the cars don't go up in value. Like, that's a thing. Obviously, we should know this is pretty basic.
Yeah.
Yeah. And Hertz has basically a double exposure to this because if you're a rental car company, then you rent your cars and you sell them into the wholesale market. And if you have a valuation decrease or, obviously, or if you want to get technical, like an accelerated depreciation schedule on that, that's fine. But Hertz sells most of their used vehicles on their own lots. So like Hertz, they'll rent out a 2020, Kia Forte, and then they turn around and sell it on their own used car lot to the next big sucker. And that was great when used car prices were just going up and up and up to infinity. But that's not the case anymore. And we've seen accelerated write-downs from Avis and from Hertz, specifically on that, as far as like the used car price depreciation. Because again, like for Hertz, it's like a double whammy on the depreciation metrics, because they're not just going straight in the wholesale market and getting rid of these things tomorrow. It takes months to offload these things into their own used car lots. So as a whole, and we've seen this, like pretty much everything except AutoZone and O'Reilly's, because like I have a watch list of like over 50 names that are just in the automotive space, and they're struggling. Like, they're not doing good.
So you're saying Carvana's a short? Got it. No, I'm just kidding, Ben. No, Ben, I can tell you've done a ton of research on that, so I appreciate you jumping up, and look forward to maybe having a little bit more of a deeper dive on it in the future. So thank you, I appreciate it. All right, so with that, it's we're about 9:50 here on a Wednesday night. That was Weekly Notebook Review. Appreciate everybody who joined. What a pleasure to have Mike Taylor on. He's a wealth of knowledge, and I'm very grateful for him taking his time to speak with all of us in Hedgeye Nation. So we'll see you guys next week. It'll probably be back to the 4:30 slot, but we'll see. I'll keep everybody posted. But with that, good luck out there. Good luck trading, and keep an eye, as I said, on that vol, the dollar, and the rates. It's those are three big components that are going to help guide you in terms of portfolio management, portfolio positioning. So with that, have a great evening, everybody, and we'll see you soon.
Don't forget to check out Hedgeye.com to get more actionable investing insights from our team of more than 40 research analysts. And check us out on Twitter at our handle, @Hedgeye. This presentation is informational only. None of the information contained herein constitutes an offer to sell or a solicitation of an offer to buy any security or investment vehicle, nor does it constitute investment recommendation or legal, tax, accounting, or investment advice by Hedgeye or any of its employees, officers, agents, or guests. This information is presented without regard for individual investment preferences or risk parameters and is general, non-tailored, non-specific information. This content is based on information from sources believed to be reliable. Hedgeye is not responsible for errors, inaccuracies, or omissions of information. The opinions and conclusions contained in this report are those of the individual expressing those opinions and conclusions and are intended solely for the use of Hedgeye subscribers and the authorized recipients of the content. All investments entail a certain degree of risk, and financial instrument prices can fluctuate based on several factors, including those not considered in the preparation of the content. Consult your financial professional before investing. The information contained herein is protected by United States and foreign copyright laws and is intended solely for the use of its authorized recipient. Access must be provided directly by Hedgeye. Redistribution or republication is strictly prohibited. For more detail, please refer to the terms of service at hedgeye.com/terms of service.